Are you able to access these slides on your portal? In the student resource area, right? So here's another thing I believe participation in the public speaking is so important. So I'll give you every chance to do that if you want. So again, if anybody wants to volunteer and present this, I'm happy to do it. Yeah. Or next class.
Do you find these on modules? Is that where you find the slides on Canvas?
In my one, it's called the teacher resources section.
Okay.
So in yours, maybe in the student resource, anybody find it?
So in modules for each chapter, and at the end of each module, there's like a slide.
Okay. You want to tell people where it is? Or you can even connect to the computer and show them.
Go to modules.
Okay, go to modules. And at the bottom, there's slides. Yeah, the modules and the chapter, and then there are slides. If you can find it later on, ask what is your name? Skylin. Come ask Skylin after class. So chapter 2, learning objectives. Identify financial effects of common business activities that affect the balance sheet. So building the balance sheet, you start with the assets, right? Assets are the resources that represent the present rights of a company to economic benefits. In the common day language, assets are what you own, that will generate cash flow for you, like equipment, buildings. Liability, the present obligations of a company, which will be fulfilled by transferring to other economic benefit. Basically, what you owe people, you need to pay people. Stock owners' equity, the excess of assets over liability, representing the financing provided by the owners in the operations of business. Take the money you put in by yourself, okay, and your partners. So assets equal liability plus stockholders' equity. So companies rely on two sources of financing, debt financing and equity financing. So liability is basically debt financing. Equity financing is basically called stock owners' equity. And assets, you get the money and you invest in assets. Assets are the equipment, tools that will help you to bring money, right? For the wedding, what are the assets for the wedding planning? Your camera, what, you can yell it out. For the wedding planning business, what are some of your assets you have? Right? Stage, DJ, the music equipment, the land you own. In order to buy the land, you basically maybe you got a liability mortgage and some down payment, which are equity, right? Thinking that way. Financing and investing activity. A company always documents its activity. Picture the document away. So every transaction is about receiving something and giving something. And it's, you need to learn to call it. For example, you buy a camera. You start to see you receive a camera. You start to put it on asset, a camera, your equipment, camera, right? And then your assets also, if you pay it by cash, your cash is reduced, by the same amount, right? So a dollar amount is determined for each exchange. Analyze the financial effect. So every transaction, you envision how it goes to the balance sheet. You buy a land, now on your balance sheet, the asset section, you have land, $1 million. And then if you put 20% down, you have owner's equity, $200,000. And you get a loan, the liability is what? $800,000, right? Are you following me? Okay, good. Be responsive, nod your head or say something, okay? So I know you are following. External exchange is basically you exchanging from, between the company and someone else. So you're buying from a vendor, for example, you're paying them for the service to come as a cameraman or the DJ, okay? You pay them $1,000. That's cash you go out to. And then that's your expense, right? Called, cameraman expense. Okay, so you have, it's always happening like that. Internal events occurring within the company, for example, using some assets to create an inventory product. Okay, so it's like this is internal. You're not selling product. So if you're buying some inventory, okay, for wedding, you're gonna sell whatever, water. So you bring some water, so your assets of inventory of water increase $100, and then your cash reduce $100. Right? Making sense? Okay. So you will see I will try to use words like increase assets, reduce assets, because I was totally confused when I was a student. Looking at the book, debit and credit was so confusing. It's not meaningful to me. That's why I use the word increase, decrease, and I hope that will help you to understand. Okay. Because increase, decrease, it's common sense. Apply transaction analysis to accounting transactions. So accounting cycle is a systematic accounting process. Is used to capture and report the financial effects of a company's transaction. So as the examples I was giving, you analyze and then you record it and then you summarize it. So a transaction is a business activity that affects the basic accounting equation. There's always duality of an event. Every transaction has at least two effects on the basic accounting equation. So assets equal liability plus stockholders' equity. Assets must equal liability plus stockholders' equity for every accounting transaction. Now, if you really look at this, the entire transaction, everything is all impacting the balance sheet. Even we have an income statement, the income statement is temporary for this time. But if you really look at it, the income statement, even its income and expense, it immediately eventually impacts the balance sheet, right? Okay. As part of transaction analysis, a name is given to each item exchanged. Accountants refers to these names as account titles. Okay, so now we are going to create account titles for your business, for your budget. So call it in a way that is professional, and also it's specific, as last time I said, so that it tells the story, you understand. But also with some kind of a common professionalism, using some common words like assets or equipment in building. And then under that, you have categories, camera and truck, like that. The chart of accounts is tailored to each company's business. So although some account titles are common across all companies, like cash, accounts payable, others may be unique to a particular company. So the uniqueness, it's actually important. That tells the story, and that will help you to understand the details of your business and your team to understand the business, right? So for example, this one, you have the cash, supplies, equipment, logo and trademark, software, accounts payable, notes payable, common stock, retained earnings. So these are mostly common. And you want to number them in the way that it has some logic in there, from the most from the most liquid assets to the most long-term assets, like that. So you want to number it. So on your chart of account, it shows in sequence. So everybody can, one thing you want to play is you can go online, QuickBook Online, and then you can sign up as an accountant version of QuickBook Online. Okay, so each person, when you sign up, just as an accountant, you get an accountant version, it's free. And you can play with it. You can start the transaction in there, play with it. And you can also watch some of the videos. So that's the first thing you want to use when you start your business. That's how you keep track of your transactions. Okay, and then QuickBook Online is really good. You can also link your bank account, and then whatever the bank, one principle you want to have is separate your business from your personal. So if it's business related to the transactions, you want to use your business account. And then the bank information will flow to QuickBook automatically. That's the beauty of it. And then you book it. Once you book it, next time a similar transaction, it will be booked automatically. And then you can generate the reports. Okay, so you can play with it. So as today I will talk to you, it's more like the manual processes. It's still good to learn the manual processes. I learned the manual way, and I did everything manually on hand. Nowadays, nobody do it on hand anymore. But if you practice it, actually, it's pretty good. For me, because I did it for like 2-3 years on hand, my brain is like a computer. So any transaction, like any accounting problem, any transaction, come to me, my brain automatically goes like, okay, it flows to the financial statement. And whatever I need to make an adjustment, I instantly know how it impacts the financial statement. Okay, so it's still good to learn the cycle. So today we'll talk about the cycle. However, in practice, in today's world, in your business, you're most likely using QuickBook Online, and you put the transaction in there, and it goes to your balance sheet and an income statement automatically. Okay, so you don't need to go through all these manual process. Today we will talk like the T account, like that. Okay, but knowing the process will understand how the computer flows as well. So let's get some examples. Issue stocks to owners. Jordan incorporates Noodle Cake Studios, Inc. on August 1st of the current year. The company issues common stocks to Jordan and Ty as evidence of their total contribution of $10,000 cash, which is deposited in the company's bank account, right? So now you imagine how it goes. So bank account, cash account, increase $10,000. And what's the other side? Equity, increase $10,000, right? Can you picture it on the balance sheet? Yeah, good. Good. Most are nodding. The ones who are nodding, not nodding, I don't know if you are there. Hello? It's too boring or sleepy. Okay, most are still reacting. Okay, so cash increased $10,000, common stock increased $10,000, right? On the balance sheet, you can envision on the balance sheet. So cash increase and common stock increase. So invest in logo and trademark. So Noodle Cake pays $300 cash to create the company's logo. What? Logo, if it's asset, you can put in assets, or you can say it's expense, right? Logo expense, which goes to the expense section of the income statement, which reduces profit, right? And then cash, reduce $300,000, right? So now you can see cash reduced $300,000. Logo trademark, if you look at this assets, increase $300,000. Okay, stop me if you don't understand, okay? Feel free. And if you're understanding, just keep nodding, saying yes, got it. Obtain loan from bank. Noodle Cake borrows $20,000 from a bank, depositing those funds in its bank account and signing a formal agreement to repay the loan in 2 years. Okay, how do you envision? Anybody want to try? So $20,000 cash increase, right? And it's loans payable on the liability section of the balance sheet, right? Does that make sense? Increase assets, liability also increases, right? And the formula always makes sense. Investing in equipment, he receives $9,600 equipment. Let's say your fancy camera for the wedding, and then give a promise to pay $9,600 on account. Okay, you need a camera, but I'm not going to pay you now. I'll pay you after I have my first client and get some profit. Then I'll have cash, right? Good deal. So what do you see? Assets?
Asset for the camera.
Yes, increase $9,600.
House payable.
Accounts payable. Awesome. Thank you. Everybody getting it? Awesome, awesome. Thank you for nodding. I need that. Pay suppliers, Noodle Cake writes a $5,000 check to the equipment supplier. Okay, so now you pay $5,000. So the liability reduced $5,000, right? And your cash also reduced $5,000. So both is reduction. In the asset section, the cash reduced $5,000, liability also reduced $5,000. Right, and you order software, $9,000. So the assets section. Okay, so this is just the promise, right? This is a tricky question. You really didn't perform the contract yet, so there's nothing happened, right? But if the person performs and you owe the person, how do you book it? Right, software expense in the asset section, right? Or you look at the software you want to capitalize. This is software increase, and then what? You haven't paid, so it's payable, right? Thank you for nodding. Everybody else getting that? Okay. And then when you pay it, again, what? You reduce accounts payable and you reduce cash, right? Got it. I'm so happy. Like accounting is so easy, right? Think about all the anxieties. After my first class, I was ready to drop class, and in fact, 30% students dropped accounting. After like this section, because the teacher was talking about debit and credit, and it's so confusing. And the book also was talking about debit and credit. So that's one thing I want to change, and I'm so glad that so many people are nodding. So that's the basic of accounting. If you understand this, like you laid the foundation. You understand accounting easily. Yeah. So Noodle Cake receives $9,000 of game code order and pay $4,000 cash, and promise to pay the remaining $5,000 next month. Okay. So now this one, it's like you receive $9,000 game code. Okay, so you say game code $9,000, right? That's the asset section, you increase. And the cash, you reduce cash $4,000. So the balance of $5,000 is accounts payable. Right, sense? A little bit complexity, but the reality is the same. So still, 9,000 equal 4,000 plus 5,000 basically. So, so you cash in the asset section, cash less $4,000, software increase $9,000, and accounts payable side is $5,000, right? Noodle receive supply costing $600 on account. Okay, you have what? Increase supply $600, and then you reduce or you increase payable $600, right? Because these are what you're paying. So this you can put these transactions. So this is what I was saying manually. You're basically putting the transactions in your spreadsheet. So this is asset section, and then these are the different assets, and each transaction you have an increase. Like okay, the first one cash $1,000, and then the common stock $10,000. As each transaction you put in there, you total up. Okay, now it's your balance sheet and balance. Cash right? So that's how you do it. The total. So that's so-called T account. So it's like a T. So in the manual ways, you have this T account cash, and then it looks like T. So this side will increase, this side will reduce, and then eventually you have a total. So in this way, we in Excel, instead of putting this side, we're just putting positive number and negative number, and then total out. So that's fine. And then if you look at the computer, behind the scene, the computer basically was calculated this way. So then it's the balance sheet of these numbers. Okay. Getting it? I'm sure everybody get it. If you get it, raise your hand. Are you getting it? Okay. You getting it? The lady who's writing, did you get it? 100%. Whoa! Give yourself a round of applause. This is accounting. This is accounting. So you should be so proud of you. 50% of the students' job after at this level. Okay, you don't need to drop. You understand this? Really, 30%. If you ask people, by this time, 30%. Like I was confused when I was student. Like what? Because all word is debit and credit. So I have not touched the word debit and credit, and you don't need to. Okay, you don't need to think about that. Okay. So record and summarize. Continued. So most companies use computerized accounting system like QuickBooks Online, which can handle a large number of transactions. These transactions follow a cycle called the accounting cycle, which is repeated day after day, month after month, the year after year. Okay, so basically analyze it, and then you have record and you summarize, so-called a T account that I explained to you, and then you have the trial balance. So basically, the bottom numbers, the balance, these are the trial balance. You can put all these together. And then, you can categorize. Some of them are assets and liability and equity. That goes to the balance sheet, and some of them belong to income and expense, goes to the income statement. That's it. So this is using journal entries and T accounts to show how transaction affects the balance sheet. So that's what I was talking about. And this is just one way to show you again the archaic manual process. Now you understand the picture of the balance sheet. These are very easy for you. But on the other hand, I warn you, if you get into it, that's where you get confusing again, because it starts to use debit and credit. But I want you to always envision the balance sheet. Whenever you debit credit, you envision the balance sheet as increase, decrease of assets and liability and equity. And easy to understand. So that's the debit and credit framework, okay? So basically, normally, the assets you increase at the left side, it's called a debit. And then you decrease, it's called a credit, okay? Again, don't worry if you don't remember debit credit. It's just give some ideas, because in the accounting world, once you get into it, they're going to use that word, but you're not to be afraid of it, okay? So liability, when you increase, it's on the right side. It's you increase it, called a credit. And then you decrease, it's called a debit, liability. Okay, so liability assets is reverse. Stock owner equity, same like liability. When you increase, it's on the credit side, okay, on the right side. And then when you decrease, it's on the left side. Okay, is this confusing enough? Awesome. So, so take special note of the 3 important rules. Accounts increase on the same side as they appear in this assets equal liability plus stockholders equity. So what it means is, asset increases, right? And then the right side, the left side, the right side liability and the stockholder equity also increases. That's how this game is, how it balances. So left is debit, right is credit. Okay, that's the account. The normal balance for an account is the side on which it increases. So the balance is at the side that increases, which means if it's assets, the balance usually is on the debit side. So if it's cash, you started with $10,000, you use $3,300. Now the balance is what? A little bit less than $10,000, right? So if you look at the cash, right, $10,000. So this is how the journal entry is looks like. So you have cash increase, you debit $10,000, and then increase common stock. That's the equity side, $10,000. And you have the logo and trademark. So debit on the asset side, $300, and you also with cash, $300. $300. Software, $900, and then you reduce cash, accounts payable, $5,000. Does it make sense? Okay. So if this debit thing confuses, forget about it. Okay, go back to what you were thinking before. Totally right. Because it's definitely totally confusing. For me, at least, when I was a student. Okay. So that's the journal entry. So every transaction at the bottom line, you always write down the journal entry like this. And then you picture, the best way is picture where it goes on the balance sheet. Okay, so the cash section will increase. Okay, and then at the bottom, stock, equity section, right? You always picture it. That's the way it will help you understand. See the picture of the balance sheet. So that's, you can bring in debit and credit. That's how it look like. So the way you summarize so-called T account is this, right? Software, the software section, and that's the bit. And then at the balance sheet of software, it's $9,000, right? And then same, cash, accounts payable. These are adding up the balance Okay, so like this, okay, $4,000, that's a balance. And then there's a balance. So at the end of the month, this balance goes to a balance sheet. Okay, so this is another example, basically goes to these so-called T account. Okay, and then eventually, so the T account is just one transition process between the actual balance sheet and this is just a transition. So in today's world, you never need to use that. The computer automatically goes to the balance sheet, right? This process is not necessary. Yeah. So but you understand this. In the old days, that's how manually we do it. In this books, you have these, and also do this. But even if you don't understand it, it's okay. You don't need it today's world. So so this is what we will done. To review it, you increase cash, increase equity, and that's how the journal entry is, and that's how you go to the T account. And then this one again, you envision that, and then you record the journal entry, and then it goes to this T account, right? So obtain loan, this is most important. As long as you understand this, this is basically how in accounting language you write the journal entry. Increase in cash, which is debit, and then increase in notes payable as credit, and the format wise, you goes in this way, and then you summarize it, goes to the T account. Yeah, all getting it? Awesome. So I'm gonna just skip some of these things. It's all the same process, right? So the same process, you play with it. So these are things that you will do it in your exercise. Just play with it many times, and then it becomes a second instinct. You train your brain to think this way in the future. Whatever happens, whatever you have a transaction in business, you immediately picture this way. Okay, and then you train your brain in a way. Eventually, as a business executive, a business owner, you look at your balance sheet or income statement. You get it. And you can deal with it. And then if you are buying a company or something, merger and acquisition, you look at the financials, you understand it. And you can ask questions, like very targeted questions. Yeah. And that's a skill. That's a skill, it's the technical skill, but give you the big picture of it. So these are the T accounts you put together, right? And then eventually it goes to so-called prepare a trial balance. Basically, it's all the bottom line of each account, and you put it together. Here are the debit, which are the assets side, and here are the credit, are the liability, and the equity side, and they always balance. Yeah, so this is the chart balance, and in a way, it's also the balance sheet, right? You can just put the balance sheet together, make it look like a balance sheet like this. I have assets, and then you make it more meaningful. Put some subtitles, and then liability section, and then the equity section. So now you add some more titles, current assets, current liability. If you have land, you put into long-term assets section, right? And here you have current liability. But if you have a long-term loan, you have long-term liability. You're just adding it more, make it more meaningful. And then you can also start to interpret. So for example, current assets and the current liability. If your current assets is less than current liability, it means you have probably, liquidity issues, you probably will run out of cash, right? So your cash is not enough to pay your payables. So that's something you can look. And then long-term liability and long-term assets, as long as they are long-term, they're fine. You're not afraid of it. Because even, for example, the example we talked about, if you bought land for your wedding planning business, it's $1 million. So your assets long-term, it's $1 million, right? And then the owner's equity is $200,000. And then your liability is long-term, $800,000. You look at $800,000, you're not panicking because on your cash account, maybe it's $20,000. You're afraid, okay, how can I pay this $800,000? Well, $800,000 is long-term. It's only $2,000 a month. Okay, so your, current assets is only $24,000, for example, for this, right? Okay, so in cash you have $20,000 and you have accounts receivable and you have business coming. You're fine. Your business will flow. Yeah. So that's the area you want to watch. Cash flow is important. That's your part. And businesses usually go bankruptcy because they can't meet the liability, they can't pay because they run out of cash. Yeah. So that's how you manage cash. And that's how what I was saying in the beginning of the class. If you don't understand accounting, a lot of business people suffer in two ways. One, they're too conservative. They don't take risks of buying the land. Okay, that's where the land, over will increase, right? Because of inflation and because of population growth, and so you lose an opportunity. Being too conservative, you lose an opportunity. Another is being too aggressive. They're not understanding finance. They shouldn't buy this land because they are not going to generate enough income to meet the liability of $800,000, which will require you to pay, $2,000 a month. And if they can't generate that income, or they're overly optimistic, then eventually they lose the land. Yeah. So that's how you want to think the financial skills at the big picture level. So this one, you ability to pay current assets divided by current liability. That's 2. That's great. Okay, if it's more than 1, you are comfortable. Yeah. So what it is and is not recorded includes measurable items acquired through exchange. Exclude other items such as creativity and vision. So that's, the limit of a financial statement. The financial statement does not tell everything. It only tells the financial, the things that made money. But a lot of things, it's important, it's intangible, it's not on the balance sheet. Okay, so you as the founder, you understand your creativity, your initiative, your go-getter, your leadership, your problem-solving skills, right? Your communication skills. These are your real assets, even if it's not on balance sheet. Right? So when you go raise fund, not only that you want to present your balance sheet, but also you want to show your confidence, your vision, your commitment, your passion, your creativity, your ability to bring people together to solve problems and to communicate. Important. What amounts are assigned initially recorded at cost, decrease in asset value are recorded, but generally increase are not. Okay, so if it's land, you bought it for $4 million, you recorded the land $1 million. Okay, now usually it's just there, but for conservative purposes, a lot of time if the market drops, right, you want to say, okay, it's $1 million, but now it's only $800,000. You lost money. You can adjust that. to conservatively do it. But if you're confident, this area, St. George is growing, you don't need to worry about that. It's a small job, and you're not going to sell it, and 10 years later, it's going to be 2 million. You're confident. That's fine, right? So with that said, when I was in college, the teacher asked, why do you take account? Why are you, studying accounting? So let me ask you the same question. Why are you studying accounting? So when I was in classroom, all the students stand up and they say, well, it's easy to find a job in accounting, and it's easy to learn business, to get your foot into the doors of business. And I didn't understand. But I got into, and all these students, like, my parents were farmers. They don't understand business. So these students, their parents are like CEOs, presidents of big companies. And they were standing up and they say their parents suggested them to study accounting because it's easier to find job. And also it's easier to get into businesses, all kind of businesses. And you have all kind of choices. Like every business needs an accounting person. So you can pick a business that you're passionate about. Be it movie business, be it restaurant business, be it whatever. You can get your foot in it. And then that's the best way to learn about the business. Right? Every business transaction goes through accounting. And you understand it. And later on when I work, I start to realize, oh yeah. Like I was working for a company that helped people get a loan, home ownership. And the entire thing, everything, I know it. It's like if I want to start a business, like I really can do it. I understand the entire intricacy, rehab, house, and everything. So I think accounting, if you want to do business, right? Accounting is like the most important skill to learn. Yes, marketing is very important, I think. But marketing, you really don't need to take a class to understand. I think it's common sense, right? Demand and supply, you really don't need to take a class, I think. You can just common sense. You see there's a demand, you do it. There's a team of this. I love that. The medical supply, it's like you, right? It's like there's a demand. There's a demand, and then there's supply, and there's a wide gap. That's business. And it's all about to go get it and just do it. What time do you have? Okay, 36 already. So let's just play this one also. Received. So okay, JK Builders. Okay, this time you guys need to do it, okay? JK Builders was incorporated on July 1. Prepare journal entries for the following events from the first month of business. If the event is not a transaction, write no transaction. So receive the $70,000 cash invested by owners and issue the common stocks. Okay, raise your hand, somebody. Somebody raise your hand. Okay, you want me to call on you? Okay, somebody raise your hand. Please. Okay, good. Okay.
Yeah.
Transaction.
For this?
Yeah. Cash increase
Yeah. Increase, then the
Common stock, right?
capital increase too.
Yeah, equity increase $70,000, right? So that's how you do it. Good. Okay. The next one, bought an unused field from a local farmer by paying $60,000 cash as a construction site for smaller projects. It is estimated to be worth $65,000. Okay. Next. Who want to do it?
Plan to be 60,000, cost 65.
Yeah, and cash this. Good. A plumber supplier delivered the lumber supplies to JK Builders for future use. The lumber supplies would have normally sold for $10,000, but the supplier gave JK Builder a 10% discount. JK Builder has not yet received the $9,000 bill from the supplier. Okay? Who want to do it?
The 9,000 for accounts receivable.
Yeah, so supplier is 9,000, right? Accounts payable, 9,000, right? So the 10% is discounted. So we don't need to pay 10%, right? Okay, borrow the $25,000 from the bank with a plan to use the funds to build a small workshop in August. The loan has to be repaid in 2 years. Okay, somebody? Good.
Accounts payable.
Yeah, so you have cash increase, right? $25,000. Yeah, and then payable, $25,000. Right. One of the owners sold $10,000 worth of his common stock to another shareholder for $11,000. Okay. There's two independent individuals. It has nothing to do with my company, right? They're just doing it within themselves. The company cash, we don't change. Okay. At the beginning of August, Percy Thomas founded bookmart.com, which sells new and used books online. He's passionate about books, but does not have a lot of accounting experience. Help Percy by preparing journal entries for the following events if the event is no transaction. So the company purchased the equipment for $4,000 cash. The equipment is expected to be used for 10 or more years. Somebody? Give a try. You can just yell it out. You don't need to raise hand. So you increase equipment, right? $4,000. And then you reduce cash $4,000, right? Percy's business bought $7,000 worth of inventory from a publisher. The company will pay the publisher within 40 days. Okay? What? Inventory? Yeah, increase in the accounts payable, right? So Percy's friend, Emmanuel, lent $4,000 to the business. Now you immediately, like what? You see cash, right? Increase $4,000. Like your brain starts to think this way now. Had Percy write a note promising to the would repay the 4,000 in 4 months. Okay, so notes payable, right? So your cash increase, notes payable increase. The company paid $1,500 cash for books purchased on accounts earlier in a month. What? You pay the cash, so of course cash you goes out, reduce, right? You credit cash, and then you have books, so you increase books, right? So basically your accounts, this is paid. Okay, so you reduce accounts payable and you reduce cash. So repaid the 4,000 loan established. Okay, so the notes gets gone and then the cash, reduce. Right? Make sense? So Sweet Shop Co. is a chain of candy stores that have been in operation for the past 10 years, prepare journal entries for the following events. Ordered and received $12,000 worth of cotton candy machine. Okay, so what? Increase machine, right? $12,000. Okay, and will pay, so has not paid, so accounts payable, right? So you have increased receipt and accounts payable. Send a check for $6,000. Okay, you reduce cash for the cotton candy. Okay, so you also reduce accounts payable, right? So accounts payable reduced, and then cash reduced. Received $400 from customer who bought candy. Okay, you increase cash. Okay, accounts receivable, right? The previously when he bought it. Now, when he bought it and he didn't pay, you have accounts receivable, right? And then you reduce your cotton candy, right? So this is the one that before that. So to help raise funds for store upgrades, estimated to cost $20,000. The company issued 1,000 common shares for 15 each. Okay, so 15 times 1,000, what? $15,000 common stock. Okay, and then they raised the what? $15,000 cash. And then you have a suite. So here's the thing, okay, when you do this, you read this, when you do exercise and do quizzes, sometimes the question is tricky. Costs you $20,000, you think it's $20,000. But the reality is, yeah, they estimated this, but the reality, they only raised the $15,000, right? So it's $15,000, okay? So that's something you think. So Sweet Shop Co. bought ice cream truck of $60,000 total. It's a $60,000 increase truck. And then you cash less $10,000 or whatever outstanding is payable. Make sense? So Blue Light received a $50 cash on account for a birthday party held 2 months ago. Okay, you receive cash, and then accounts receivable reduced, right? And agree to hire a new employee at a monthly salary of $3,000. The employee starts work next month. Huh, this is just an agreement, there's no transaction. Paid $2,000 for a tabletop hockey game purchased last month on account. Okay, on account means at that time when it was purchased, what you increase the tabletop and accounts payable. Now it's basically you reduce the accounts payable and reduce cash. That's it, right? So I think you get it. You can play